Gold, I say, doesn't have a whole lot of upside left. I think that move is done. I think you can still be in it. I think it might still want to drift higher. The chart still looks really good on a daily chart, but overall, this is not a place to be buying gold. I do feel like we're going to see gold pull back probably 25 to 35%, somewhere back down into the middle of this range, which really comes into this high. It's very similar to what we saw in the 2008 financial crisis. Gold pulled back 34%. Silver pulled back like 67%, something like that. Yeah, you could say it is overbought. I wouldn't buy it here. I think there's going to be a great opportunity for precious metals once this music of the whole economy and the stock markets, all this stuff stalls. And this is what I've been preaching for a while. I'm super excited. I can't wait for the precious metal space. I can't wait for a financial reset because then real estate, all these things are going to become amazing opportunities.
A massive decline followed in 2008. So the implications are, of course, very bearish for all those markets, including world stocks. Spurred by the 9/11 attacks and the geopolitical instability which followed, gold's bull run during Bush's presidency from 2001 to 2009 could have been even greater had the 2008 global financial crisis not occurred. Instead, fear of deflation and a flight to the safety of the US dollar resulted in a 30% dip from the peak to trough of gold prices in 2008. Internationally recognized technical analyst Chris Vermeulen states that gold may face a 25 to 35% pullback after reaching the $2,700 range, similar to its 2008 performance. He advises caution when buying gold now, expecting better opportunities later. Notably, gold's strong performance during market crises, such as the 2008 financial meltdown, highlights its value as a defensive asset during turbulent times. Regarding gold's performance, Chris notes that while it has risen steadily, it hasn't reached an overbought state or attracted excessive buying. He suggests that gold is approaching its peak based on long-term technical indicators. Commodity analysts who make long-term forecasts believe that the price of gold will generally keep rising in the next few decades as the demand for the precious metal increases. In a research paper recently published in the journal Trends in Ecology and Evolution, Josep Peñuelas, a research professor, warned that by 2050, the world could run out of essential metals, including gold. Despite gold's all-time highs, Chris points out that miners remain underperforming due to rising extraction costs. He predicts that the sector hasn't fully gained momentum yet, and expects GDX to drop $15 to $25 in the event of a financial reset. Experts like Peter Schiff also state that gold has set to have its best year since 1979, when it rose 126%. Yet the GDX is only up 31%. That means investors still haven't noticed the bull market or added mining stocks to their screens. Now we present the clips of Chris Vermeulen's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I don't think it's overbought. I don't think there's euphoria and like everybody's piling into it. It's drifting higher. It's not like it's got crazy volume. Gold, you and I have been talking for quarters, really. I mean, when we look at the weekly chart or the monthly chart of gold, it doesn't matter how far back we go. We can take this Fibonacci measured move. We can go all the way back to the beginning of the early 2000s during this rally and pull back and do a Fibonacci measured move. All the time frames actually point to 2650 to 2750. We're now at like more or less 2677. So we're in that window that goes all the way back like 20 years, 24 years almost, where multiple price charts are saying, hey, when you hit 2650 to 2750, gold's probably going to be about done its move, and we're going to see some huge shift. We're going to probably see the stock market change, reverse, probably gold, the economy. There's going to be a whole new pivot, be a whole new world once the market has this new financial reset, whatever they're going to call it after it's done. So gold, yes, gold, I say, doesn't have a whole lot of upside left. I think that move is done. I think you can still be in it. I think it might still want to drift higher. The chart still looks really good on a daily chart, but overall, this is not a place to be buying gold. I do feel like we're going to see gold pull back probably 25 to 35%, somewhere back down into the middle of this range, which really comes into this high. It's very similar to what we saw in the 2008 financial crisis. Gold pulled back 34%. Silver pulled back like 67%, something like that. So yeah, you could say it is overbought. I wouldn't buy it here. I think there's going to be a great opportunity for precious metals once this music of the whole economy and the stock markets, all this stuff stalls. And this is what I've been preaching for a while. I'm super excited. I can't wait for the precious metal space. I can't wait for a financial reset because then real estate, all these things are going to become amazing opportunities. And right now it's like we're in this peak risk. I have like just a simple chart here that just shows as an investor, if we were to just zoom in on this one particular chart, we are in this phase right here of peak maximum financial risk. I don't care what you put your money into right now. I don't think there's a whole lot of upside left in anything like stocks, bonds, even like government bond. Like if you put them in like a GIC, like in Canada, and try and make your rates are going down. Like there isn't a safe place really anywhere unless you take advantage of a falling market, which through inverse ETFs or playing a different asset class that might go up, like the US dollar, if everything collapses. So we're in this point where it's like we all have capital, we want to invest, we want to make more money, but we're actually have to kind of sit on our hands and just know we're in a very difficult market condition that's really difficult to trade. We're in this stage 3 top. It's choppy. It's been like this since 2021 for small cap stocks, most sectors. And we just have to know like this is like just preserve capital, put up with average kind of poor returns and wait for stage 4 decline or a new major bull market to start. I don't care which one happens, preferably a stage 4 because things need a reset. It's good for a lot of people. So that's kind of where I see things at this point. If we look at GDX and we look at the chart, gold would be equivalent to trading like way up here, all-time highs.
Yeah, that's right.
And miners are struggling. They're way off. But the thing is, I mean, gold miners, I don't follow their fundamentals too much, but I know everything is crazy expensive. And I know it costs a hell of a lot more to get gold out of the ground and process it and everything now. That even with gold being up at all-time highs, I still think the profits are still really down. I think gold has to have that huge pop and break to really extend. And this space just doesn't quite have the love. I mean, I don't think it's just it's a mass move play yet. And right now it's a lot of people in the space moving in, driving the markets up, but it's not like we have like crazy massive volume. It's not headline news everywhere. So this is just, people, I think actually a little too early to the game. I think we're still going to have a financial reset. I think miners are going to be like GDX could probably be very easily back at 25 or 20 if we have another financial reset, maybe even 15. I mean, it dipped down to 15 in 2008. It could very easily do that. So from a fundamental standpoint, I still think fundamentally they're not really that good. Now there might be the occasional gold miner that's like crushing it and should have crazy pricing, and it's not. And that's because it's grouped into the mindset of gold miners, and they're just not moving. It's just not a fully live sector yet where it's breaking free new all-time highs.
During the interview, Chris Vermeulen expresses surprise at the Fed's 50 basis point rate cut. He predicts this has sparked a buy the rumor, sell the news reaction in bonds. From a technical viewpoint, Chris underscores that after the rate cut, he shifted from bonds to equities, expecting short-term gains. Traditionally, big Fed interest rate cuts and equity prices hovering near all-time highs are ominous signs for the stock market. Despite large Fed rate cuts typically signaling a recession, some analysts believe the market is set to benefit from an unusual best-case scenario, even with record-high stock values. Dietrich's analysis shows that when the Fed trims rates to bring them back to normal after a flurry of rate increases, the S&P 500 climbed an average of 13.2% in the following 12 months. That's mostly why Fed officials say they're bringing down rates now. However, he predicts that rate cuts signal deeper economic issues, and he's bearish on the market long-term, anticipating a significant correction within a year. Let's get back to the interview.
I was really expecting myself. I mean, I don't really follow the fundamentals and the rates that closely, but I was thinking it was going to be a quarter basis points. I figure if they go any bigger than that, they might shock the market a little bit. And they ended up doing that. They did a 50 basis point cut, which sparks the question, what do they see that's really bad that we don't know? Because I really don't feel like the economy, I don't really think we need that big cut just yet. Maybe it's because a lot of other countries they're already in a recession. They've already started cutting like Canada, and they want to maybe catch up a little bit. I'm not sure, but that's kind of a red flag that they've cut that much, in my opinion. Now, in terms of, for example, like bond pricing, as soon as they cut rates, generally, that's bullish for bonds, bullish for the stock market. We have seen the stock market rip to the upside. Simply, if you're going to get lower rates elsewhere, it's going to want to funnel you into the stock market to make more money. But we have seen bonds, long-term treasury bonds, they've pulled back in price. I think it's been a big chunk of that has been kind of buy the rumor, sell the news. It's the same with any large company that, they get good earnings, could be, OpenAI or something, but or Nvidia, but the earnings aren't as good as people want, and they sell into it, even though it's really strong data. And so I think that's a little bit of probably what's gone on. I think people have been expecting rates to stop going up, to start coming down for really like a year. You look at the long-term chart of bonds, there's been already a lot priced into the bond market. So I think this is just buy the rumors, sell the news. If we finally have the rate cut, bonds are pulling back. People, I think, anticipated that like a year ago. And so people are just kind of moving out of bonds, just driving the price down a little bit. But I do think bonds are still in an uptrend. I think they're going to rally. Still over the next several weeks. Initially, we were looking to be long bonds. We were in the bond market in TLT, and then we've got the rate cut. And now, lower rates is generally pretty bullish for equities short term. And we've seen equities really pop and rally. And so our strategy that we follow in the money flows and all those things from a technical standpoint have been telling us, hey, get back into the stock market because it's more volatile than bonds generally. And there's more potential upside in the near term for equities. So we've rotated from TLT, we're back into the equities market, and I'm anticipating this market to keep running higher. And we generally see the stock market move higher after the first rate cut, and it can do that for a little bit. Now, the flip side here is, to me, rate cuts are very bearish. Short term, people buy into the equities market, which is what we've seen, but it means the Fed sees something we don't. Things are getting weaker. And typically, the rest of the rate cuts are usually the Fed cutting rates to try to soften the landing, to try to preserve the equities markets. And they're lowering rates as the stock market collapses. So I think the Fed is kind of a little bit ahead of the gun here, a little bit ahead of the schedule, trying to front run things and soften things even more. But overall, I'm still net, longer term, I'm bearish on the markets. I do think we're going to see a bigger correction down the way. And this is just part of that journey to get there, because this is a very, very big bull market cycle. It takes a long time for all this stuff, not only the technicals and the stock market to stall out, but for economics and policy, all this stuff to change for things to really kind of take hold. So my outlook from last time you and I talked is I'm still bearish looking forward like a year from now. I think the markets could be sharply lower, but the equities market is still trending higher. And I think bonds can move higher here as well.
According to experts, long-term demand for gold is expected to rise. Any short-term dips could present strategic buying opportunities once market conditions stabilize. Do you believe the potential pullback in gold presents a better buying opportunity? Or will gold's long-term upward trend continue uninterrupted? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.